Okay, so you want to grow your business, but traditional funding just isn't vibing with you.
Yeah,
Like
exactly.
maybe handing over chunks of your company.
Right.
Or getting stuck with these massive loan payments even when things are slow. Not ideal.
Not at all.
Well, that's where this thing called revenue-based financing, or RBF, comes in.
It's like having a silent partner who only gets paid when you win.
And that's what we're diving deep into today. We've got research, articles.
Oh, yeah, we've got a stack of info here.
Some of it's pretty surprising.
Definitely some eye-opening stuff.
For example, I had no idea RBF has roots in the oil and gas industry.
It's true. Back in the 90s, it was mainly used for financing oil and gas exploration.
Wow.
But it wasn't until the 2008 financial crisis that RBF really started getting traction in the wider business world.
Oh, interesting.
Yeah, traditional lending kind of dried up back then.
Right.
And these innovative fintech companies, they saw an opportunity, to adapt the RBF model for small businesses
Makes sense.
across all sorts of industries.
So it was born out of necessity, but clearly it's found its place.
Definitely has.
And now we're seeing this crazy growth. Like the global RBF market is projected to grow at over 60% annually.
Yeah, it's booming.
Why is that? What's driving that?
I think a lot of it has to do with the rise of e-commerce
Oh, yeah.
and subscription models.
Right.
Those are really natural fit for RBF.
That counts.
These businesses, they often have strong revenue streams,
Mhm.
but they might need more flexible financing options.
Right. The kind that traditional lenders just don't offer.
Exactly.
Yeah.
Exactly.
Okay, so let's get down to the basics. What exactly is revenue-based financing?
All right, so at its core, RBF is an investment where you receive capital in exchange for a percentage of your future gross revenue.
Okay.
And that means the repayments, they fluctuate with your business performance.
Interesting.
So higher revenue, you make a bigger payment, lower revenue, smaller payment.
Got it.
It's designed to align the incentives.
Between the business and the funder.
Exactly, yeah.
Yeah, that's a pretty different model than what most of us are used to.
It is.
But is it actually better? I mean, what are the real advantages here compared to, say, a bank loan or giving up equity to investors?
Well, you already touched on one of the big ones, flexibility. Unlike a traditional loan where you have those fixed monthly payments, RBF adapts to your revenue flow.
Okay.
And this can be a lifesaver, especially for businesses with seasonal cycles.
Yeah.
Or if they have unpredictable income streams.
Right, so less pressure during those slow periods.
Exactly.
But what about control? You know, a lot of small business owners, they're fiercely independent. They don't want to answer to investors.
Right, and with RBF, they don't have to.
Yeah.
One of the major advantages is that it doesn't dilute your equity.
Right.
So you keep full ownership and control of your company.
That's huge. You get the funding without giving up a piece of your dream.
Exactly.
What about speed? You know, bank loans, they're notorious for taking forever to get approved.
Oh, yeah, speed is another big plus with RBF. The approval process is generally much faster than those traditional bank loans.
Okay.
RBF providers, they're using technology and algorithms these days to streamline the application process.
Interesting.
And they tend to focus more on a business's future potential rather than just its past credit history.
So it's a bit more forward-looking,
It is.
not just looking in the rearview mirror.
Exactly.
I like that.
Yeah.
And since the funder's return is tied to your revenue, I guess they're more incentivized to actually help you succeed.
Oh, absolutely. Many RBF providers go beyond just providing capital.
Really?
They become more like partners, offering guidance, mentorship, and access to their networks.
So it's like having a built-in advisory board.
Yeah, you could say that.
Okay, but let's be realistic. It can't all be sunshine and roses.
Of course not.
What are the downsides here?
Well, one of the main drawbacks is that it can be more expensive overall than traditional loans.
Okay.
You're essentially paying a premium for that flexibility and faster access to capital.
So there is a price for convenience.
Yeah, there is.
What else should people be aware of?
Well, even though the flexible payments are designed to help with cash flow, they can also be a challenge,
Oh, how so?
especially during those peak seasons.
Right.
When your revenue is high, a good chunk of it will go towards repaying the RBF.
Right.
And that might limit your ability to reinvest in other areas of your business.
So it's like a trade-off, easing the burden during slow times, but maybe sacrificing some growth potential when things are booming.
Exactly. It's a balancing act.
And it's important to really understand the terms of each RBF agreement.
Oh, absolutely.
Some might have restrictions on how you can use the funds. Others might limit your ability to take on more debt.
Yeah, you really need to read the fine print.
So it's not as simple as just signing on the dotted line. You need to make sure the terms work with your overall business strategy.
Definitely. RBF is a powerful tool, but it's not a one-size-fits-all solution.
Okay, so who is the ideal candidate then? What kind of business should be seriously considering this?
One of the biggest things is consistent revenue.
Okay.
RBF is great for businesses with strong, predictable revenue streams.
So if your revenue looks more like a roller coaster, not a good fit.
Probably not the best, no.
What about high-growth companies?
Those can be prime candidates, too.
Yeah.
They need access to capital to fuel their expansion.
Right.
But they might not have the assets or the credit history to qualify for those traditional bank loans.
So RBF is a little more forgiving in that sense.
Yeah, it's willing to take more of a chance.
And we can't forget about seasonal businesses.
Oh, absolutely not. That flexible repayment structure, it can be a real lifesaver for them.
So RBF understands the rhythm of their business.
You got it.
Any other types of businesses that tend to gravitate towards RBF?
Businesses with high gross profit margins tend to be good fits too.
Makes sense.
Because since repayments are based on revenue, a healthy profit margin allows them to handle those payments.
Without squeezing their operation.
Exactly, yeah.
Okay, so consistent revenue, high growth potential, seasonality, strong profit margins, these are the hallmarks.
Yeah, those are the key things to look for.
What do you need to know before you even think about applying?
Well, first, you really need to understand those loan terms.
Okay, any specific ones we should pay extra attention to?
Yeah, two crucial ones are the repayment cap
Okay,
and the revenue share.
got it.
So the repayment cap, that's the total amount you'll repay, including the principal and the lender's fee.
Okay,
It's expressed as a multiple of the initial funding amount,
I see.
and it acts as a ceiling on your total repayment.
So no matter how well you do, you know exactly what your max repayment will be.
Exactly, it's like a safety net.
Okay, and then the revenue share.
So that's the percentage of your monthly revenue that goes towards repayment.
Okay,
And it's important to note that this comes out of your gross revenue, not your profit.
right. So before you even get to your profit.
Exactly. So you got to factor that into your financial planning.
Makes sense. You need to make sure you can actually afford those payments.
Absolutely. You need to make sure the numbers work in your favor.
Okay, so we've got loan terms down. What else?
Eligibility, while RBF is generally more accessible than those traditional bank loans,
Right.
there are still some basic requirements.
Like what?
Most RBF providers, they'll have a minimum monthly revenue threshold.
Makes sense.
It could range from $10,000 to $100,000 a month, depending on the lender.
So if you're just starting out,
Yeah, if you haven't hit that sweet spot, RBF might not be an option just yet.
what about operating history?
Most lenders prefer to see at least 6 to 12 months of operating history,
Okay.
just to assess a business's stability,
Right.
But some RBF providers are more focused on future growth,
Got it.
especially when it comes to startups with strong potential.
So it's not always about how long you've been around, but more about where you're headed.
Exactly.
What about credit scores?
Well, they're not as critical in the RBF world as they are with those traditional lenders, but most providers will still do a soft credit check.
That's part of their due diligence.
Yeah, it's not a deal breaker, but a good credit score can help.
So it's still worth keeping an eye on.
Absolutely.
All right. What about actually preparing for the application itself?
The most important thing is getting your financials in order.
Okay.
RBF providers will want to see your profit and loss statements, balance sheet, and cash flow projections.
Got it.
Make sure those are accurate and up to date.
So organization is key. No shoeboxes full of receipts.
Exactly. It also helps to have a solid business plan in place.
Right?
It can be really valuable to showcase your vision, your strategy.
Show them you've thought things through.
Exactly. They're not just investing in your business today, they're investing in where it's going.
And don't forget about your online presence.
Oh, that's a good one. A lot of providers will check out your website, social media, online reviews.
It's like putting your best foot forward in the digital world.
Exactly. First impressions matter.
Okay, to recap, understand those loan terms. Check your eligibility. Gather your financial documents. Polish that business plan. Give your online presence a makeover.
You got it. And one final tip. Be ready to show your revenue history and some solid projections.
Okay, I think we've laid a solid foundation here.
Yeah, we've covered a lot.
But there's still so much more to explore.
Absolutely.
We need to talk about that actual application process.
Right.
How to negotiate favorable terms, and then what it really takes to manage your RBF agreement once you've secured that funding.
That's the key, making sure it works for you.
We'll dive into all of that in the next part of our deep dive.
Sounds good.
But before we get ahead of ourselves and start talking about the future of RBF, let's make sure we fully understand the nuts and bolts of this financing option.
Yeah, let's break it down.
Let's dive into that application process itself. and really equip you with the knowledge and strategies you need to make RBF work for you.
Let's do it.
We'll be right back after a quick break.